Okay, good afternoon and welcome to today's lecture. Hello. I can be heard. I just switched my device.
Yes, we can hear you.
Okay, and you can see the screen as well.
Yes, please.
Yes.
All right, thank you. So today we're going to go through, over the past weeks, what we managed to do was to take you through how to record transactions, how to prepare your journals, prepare a trial balance, and then eventually prepare an account. Now, the account that has been prepared, we want to see how best we can interpret the account. So if you manage or an account is presented to you, how do you make sense out of the account? Because usually the accounts are a string of numbers. You only see a few words, but those numbers should mean something. If those numbers don't mean anything to you, then the financial statements may not be useful to the user. Now, when we began, we identified several users of the financial statement. We realized that there are key stakeholders or people who are interested in the financial statement. Who are these people? We recognize that investors, that is, people who are interested in investing in a particular organization, be it a healthcare organization, an investment company, or any form of business, the investor would want to see what the financial reports or statements are so that they can make an informed decision based on the reports. Again, the owners, those who have established the organization, would also want to see the financial report or statement and make an interpretation out of it. If we skew it to a professional organization where members pay dues to the organization, they would want to see how the leaders they have elected into office have steered the affairs of the organization. Mind you, every activity of an organization has some financial underpinning. Any activity that you do as an organization has a financial implication. It is either money is going in to the organization or money is going out of the organization. And that would be recorded in the form of a transaction. And it will go through all the processes, documentation of the transaction, preparing your ledgers and everything, and then eventually ends up into a final account, which may come in a form of a summary. So anything that the organization does or the leaders of the organization does would reflect in the financial report. And so the member who has been given a copy of the report should be able to make an informed decision based on what has been presented to them. So members of professional organizations, unions, and any type of organization would be interested. Now, technically, when we say members in finance or in legal terms, when we say members of an organization, we actually means people who have contributed money to the organization. These are referred to as members. So, although some organizations may have what we call honorary members, technically they are not members because they don't have financial commitment to the organization. And so they may not be able to question what the funds have been used for. Okay, even though they are honorary members, they may not even have a voting right. They cannot elect the leaders of the organization. So when we say members, technically we mean those who have financial interest in the organization. So they will be interested in the reports. Employees of the organization will also be interested in the reports. The banks, your bankers, will be interested because the banks would give you loans or would have given you loans and overdrafts. So they'll be interested in what you have used the monies for. Suppliers, those who provide the resources that you need for your organization to provide the services. They are also interested in your financial statement. Existing suppliers and potential suppliers, they want to see what kind of performance this organization is undergoing. Customers are also interested. Government. Government here could mean GRA, Ghana Revenue Authority, and any other government agency that has an interest in your organization would be interested. So HEFRA should be interested in your financial statement because you pay license fee, you pay renewal fee. So they will be interested. They want to know whether you'll be able to continuously pay or renew your license. National Health Insurance Authority will be interested in knowing your financials. Private health insurance organizations are also interested in knowing your financials because they are going to do business with you. They're going to provide some sort of services to you, and they want to be sure that you are in a position to play your part. And then the general public, especially for public organizations. Now, again, when we say public organization, it could mean two things. A public organization could mean that this is an organization that has been established by government. And so every taxpayer should be interested in what their taxes have been used for. It's been used to establish a hospital. They should be interested in what the performance of the hospital is because it is their money. Now, the other definition of public organization is an organization or an entity that has been listed on the Ghana Stock Exchange, and for that matter, any other stock exchange. So if you list an organization, say today, MTN, we are all aware MTN is a listed organization. It's on the stock exchange. So MTN is a public organization. It doesn't mean that it's been set up by government. It means that anybody or any investor who is interested in doing business with MTN, that is buying shares or selling shares of MTN, can do so publicly without having to go directly and contact MTN. All they have to do is to go to the Ghana Stock Exchange. If there are some shares they want to buy, they can buy. If they have existing shares they want to sell, they can sell. And that information regarding MTN's performance is publicly available. So that is why such an organization is referred to as a public organization, and so many other organizations. So if you pick the Ghana Stock Exchange, the listing, you see so many of them. All those organizations are public organizations. And so their name would not be, say, MTN Ghana Limited. It is going to be MTN PLC. PLC means Public Limited Company. So any organization that has PLC attached to it is a public limited organization or company. It means that it's been listed and that the whole public is interested, or any member of the public is interested in that organization. This is different from a private organization, which would be read, let's say, MTN Ghana Limited, LTD. The LTD just means that it's a private limited organization. So if you want to buy their shares, you can't go to the stock exchange. You have to contact the existing owners. So go to the company or their representative and go and do business with them. So I've taken this opportunity to explain these things. So all these key stakeholders are interested in the financials of the organization. We'll go through them one after the other. And then along the line, if there is anything you don't understand, you can stop me and then ask your question. Now, investors. So today we have a private organization, let's say Nyaho Medical Center is a private organization, it's not listed. If today the owners decide that they want to list it, then now it becomes a public organization. Anybody at all can ask for their financial statement. And indeed, most of these public limited organizations would have their financials on their websites. So today, if you go to GCB website, you expect to see their financial report. If you go to MTN, you expect to see their financial report on their website. These should be available because they are public limited organizations. Now, investors, or depending on the kind of users, okay, we've seen the various users: investors, employees, lenders, owners, government, and all those things. Each and every one of them have specific interest in the organization in terms of their financials. So an investor, for instance, the kind of information they will require from this financial statement is information that would help them to assess the risk and returns. What is the level of risk of this organization? If I should put my money in it as an investor, how much would I get or intend to get? What is the relationship between the risk and return? This is what the investor or potential investor will be interested in. In terms of the dividend, what is the security of the dividend in this organization? Is it that every year I'm going to get dividend? Or this organization pays dividend every 5 years or every 2 years? Or this organization is not interested in paying dividend at all? All they are interested in is future growth. So the money or the profits that they make, they put it back into the organization to let it grow. Is that the kind of business or entity I want to invest in? So you as an investor will have to decide which is your interest. Is it that you are interested in dividend, or you are interested in growing your investment, or you are interested in both? So you look at the financial performance of the organization or the financial statement of the organization, and you'll be able to determine whether this fits into your requirement as an investor. So typically, what such investors will be looking at is doing trend analysis. So they will compare the financial statements, let's say for the last 5 years, and look at the changes in revenue, changes in the cost, and then the profit over the past few years that they are assessing it. They also look at what we call dividend cover. Dividend cover basically is telling you the profit that you have made at the end of the year or at the end of each year. How many times can that profit pay your dividend? So if your profit is, say, 100 cedis at the end of the year, and then you are paying a dividend of 10 cedis, it means that your profit can pay dividend 10 times because your profit is 100 cedis and then the dividend is only 10 cedis. So that profit can pay dividend 10 times. Compared to another organization whose, say, profit is the same 100 cedis and then their dividend is 1 cedi, it means that this organization can pay dividend 100 times. Hello, somebody's mic is on. Do you want to ask a question?
Please say that again.
Okay, so I was saying that as an investor, your interest is that you are looking at two things. Now, let me explain this, that any investor in an organization is looking for two things, mainly in terms of the returns they are making or they anticipate to make from the organization. They are looking at either dividend or the growth of the organization. Now, if it is dividend, it means that you are taking your money back now. If it is future growth, it means that you are interested in the growth of the organization to become bigger. Now, if the organization becomes bigger, your share becomes bigger and your worth also gets bigger. So it's either you take it now or you want it to grow so that in future you could sell your share and then make some profit out of it. Because once it's growing, if you put in, for instance, let's say you invested 10 cedis and then the organization has grown over the past 5 years. Now your share in the organization probably will not remain at 10 cedis, it is now going to be 50 cedis. At that point, you may want to sell it and make your 50 cedis. I hope that is clear. So it's either you're looking for dividend, that is money now, or money in the future, or both. So that depends on you as the investor, what kind of returns you want from this organization. Okay. And I was explaining dividend cover, that these are the details that the investor or potential investor will be looking at. Dividend cover simply means that how many times will the profit that has been made be able to pay dividend? Assuming you want to pay dividend several times, how many times can it pay? So if you made a profit of 100 cedis, and then your dividend that you pay is usually 10 cedis, it means that this organization can pay this dividend 10 times without much problem. Compared to an organization that is paying a dividend of 90 cedis out of 100 cedis profits, it can only pay dividend once. It can't pay it more than once. So comparing these two organizations, one that pays dividend more than the other, which one suits you, your investment profile? Which one, as an investor, which one do you want? So that one, there's no, I mean, it's not cast in stone. You decide what you want as an investor. Okay, let me quickly move faster so that we don't spend too much time. Okay, so I've also explained that they will also be interested in share price. So for instance, if it's a listed organization, so we're still using Yahoo Medical Center. That is what comes to mind, readily. If Yahoo is listed on the stock exchange today, and you bought a share for, say, 10 cedis, after 5 years, you expect that the share price would have gone up to, say, 50 cedis, so that you can sell it probably and then make your return. So you'll be interested in the share price in the financial report that has been presented to you. Now, within the financial report, you also anticipate to see things like corporate governance report. Okay, this is something that is not usually being reported by many organizations, but there's a drive to encourage organizations to be doing that, so that corporate governance is very critical. If you remember the financial sector problems or challenges that Ghana went through recently, one of the key things was corporate governance. Okay, so an investor will be interested in all these. Now, employees, what is your interest regarding financial reports? You are interested in the stability of the organization. If the organization is stable, your job is assured, all things being equal. Is the company able to pay bonuses or higher salaries? You want to know, and you can know that through the performance or the financial report that has been presented to you. Now, things like profitability will be the key interest, and then the cash position. Does the organization have cash? Now, note that you can have an organization that is doing so well in terms of profit, but they don't have cash. I believe you know why. An organization can be very profitable. They say, oh, he's making a profit of 100 million at the end of the year. But when it comes to cash, their cash is only maybe 200,000. So as an employee, you want to be sure that they can continue to pay your salaries. Your job is secured and all that. You want to know whether there are or there will be possible increases in your salaries. And then that of the directors, their remuneration, are they going to go up? Ideally, the remuneration of directors are expected to be presented in the financial report. Not just directors, but also key personnel of the organization. Their financial remunerations or their remunerations are expected to be part of the report, because these are people you have either appointed into office as directed or elected as leaders of the organization. So their remuneration is expected to be part of the report. And this has also been emphasized by the by Ghana's companies, what do you call it? Companies Act. So it's in there. So if we are not doing it, maybe we should be preparing to do it. Lenders, your bankers are also interested in the financial reports, because they would have given money to you in the form of loans. They want to know whether you have enough cash flow to pay the loans. Again, they will also be interested in what we call interest cover. Interest cover is simply looking at the profit that you have made. How many times can that profit pay the interest on the loans that you have taken? So just as we saw with, what do you call it? Dividend cover. The dividend cover is an interest for the investor or potential investor. Interest cover is an interest of who? The bankers. Let me check this. Okay, they say I should keep the pace. No need to go fast. All right. So interest cover, yes. The interest that you are paying on the loan, okay? Your bankers are interested in knowing how many times can your profit pay the interest. The more times your profit can pay interest, the better. And then the bank will be at ease. They know that even if something happens to your profit, maybe COVID came and then your financials has distorted, you still have a large profit to be able to pay what? Their interest. So they'll be interested in knowing what your interest cover is. They want to know whether there are new charges created over the entity's assets. So they have given you loan, okay? And then you've gone to another bank to take a loan. And then that bank has imposed some charges on your assets. They want to know, because if they've imposed charges on your assets, it is likely that you will not be able to pay up their interest or their loan if something happens, because you've already used that to guarantee for another bank's loan. So they'll be interested in knowing if you have done any charges on your assets. Suppliers. Clearly, suppliers will be interested to know if you will be able to pay the suppliers when they deliver. So they'll be interested in knowing what your net current asset is. That is your assets less your liabilities. That is your total assets less your current liabilities. Do you have enough to be able to continue to pay for the supplies that they provide for you? They want to know whether this organization is growing so that they can keep supplying, because probably your demand of their supplies is going up. And so they want to know whether it matches with the growth of the organization. They are interested in that. Customers. Customers you provide services to. They want to know whether the organization is growing and then the cash flow. If the organization is growing and then providing or having enough cash flow, chances are that they will be able to continuously provide the services. Now, note that customers are not just individual customers. You can have customers that are institutions or organizations. They are also your customers because you provide services to them. So they will be interested because they are also dependent on what you supply to them to also provide what? Services. It is either they are consuming it or they are using it to provide other services. So they would want to know whether this organization is growing, whether they have cash flow to continue to provide the services they are providing to them. So that would be the interest of customers. Governments will be interested in whether your revenue is growing and then whether you are making enough profit so that you can pay taxes. And they are also interested in knowing whether the activities you are undertaking are being regulated. So as a healthcare organization, they would want to see whether you have an interaction with HIFRA, or for that matter, your respective regulatory agencies, i.e. the Medical and Dental Council, Allied Health Professions Council, Pharmacy Council, and all those ones. They want to know whether you are up to date with them, you are paying up whatever you have to pay and all that. Your tax, as we mentioned, whether you are paying taxes, government is interested. And I also mentioned whether you are creating employment or you have the potential of creating employment. Sometimes the nature of your organization can even attract government to give you certain, let me say, advantages or allowances. So sometimes they can say, okay, we've seen that you are employing a chunk of people within your locality. Okay. Now, if you are buying this asset to run your business, we are also going to give you some allowances. Now, if you are going to spend money to buy that asset, all things being equal, it will help the growth of the organization. And then you are going to also employ more people. And government will be happy that you are going to employ more people, because all these people will also be paying tax to government. And then it will also reduce the burden on government in terms of what employment. So they will be happy to see that your organization is growing. Once it is growing, government is also happy. All right. And then the general public are also interested in things like environmental and social awareness. Are you an organization that is socially and environmentally friendly? All these are expected to be in your reports when you report on, say, your corporate social responsibilities. Okay, do you have any contributions you do to the local economy or the local community within which you live? Maybe you have corporate social responsibility. At the end of every year, you carry out free medical examination or screening for the people within your organization, or even your own health, or your own employees. All these things are expected to feature in the financials. So general public will be interested in that. They'll be interested in environmental reports. If you're a Galamsey organization, what kind of report are you putting out in the financials? What kind of impact does it have on the environment, on our water bodies, and on the health of people living within the catchment areas? Directors' report. Every financial report is expected to have or accompany with it the report of the directors. The report of the directors will give you a summary of what has happened in the past, what has happened currently with respect to this particular financial report, and then what they anticipate to happen in the future. All these are expected to feature in the financials. And then narrative business report. That also will be captured by the director's report. So basically, these are the key stakeholders and then the kind of information they will require from the financial report that has been presented to them. Any questions before we look at the financial ratios? I hope I wasn't running too fast. Hello, Mr. Omari. Yes, your hand is up. Please go ahead.
Yes. Yeah. My question is the narrative report. What exactly is the narrative report?
Okay, so narrative reports, most of the financial reports you see are figures. The narrative reports are actually what we call non-financial information. Non-financial information. For instance, let's say you couldn't pay dividend in the current financial report. You'd want to explain why you didn't pay dividend. It's a narrative report, right? Or you've changed head office from Central Region to Greater Accra Region. You want to give us a narrative report, just a narration. Or there has been a resignation of some of the directors. Those ones may not be so explicit in the financials. Maybe if the directors have not been replaced, what you would see is that the director's remuneration would have reduced. And so by implication, anybody seeing that would comparing it to the previous years would think that, oh, there's been some reduction in the payment of directors' remuneration. Know that it is coming as a bulk. Maybe you have 5 directors, 3 have resigned, left with 2. And so their remuneration would have reduced. Now, it may not be so clear for everybody. People might think that, oh, directors have reduced their salaries. No, it is because some directors have resigned and they've not been replaced. So these narrative reports will catch all these aspects of the report. So at the end of the day, you are not only presenting a financial report, but a company-wide or an organization-wide report so that it will capture everything. Remember, we said that anything that happens, any activity within the organization has financial implications. And so sometimes we capture them in the financials and then they are not so clear on the face of the financials unless you provide these narrative business reports. Or again, you are looking into the future as an organization. Maybe currently your performance is not so good, but that is because you've spent so much money investing in new equipment, buying new machines for your theaters, for your labs, and all those, or expanding your pharmacy. So you would want to explain to your shareholders, potential shareholders, employees that, oh, the reason why our performance has not been so good this year is not because we didn't do well. It is because we spent so much money expanding the organization. So narrative business review will bring all these things to light for you to understand, or for anybody interested to understand. I hope that is clear.
Yeah, I'm clear now. Very clear.
Okay, all right, thank you. Any more questions before we look at the financial ratios?
Yes, I have a question.
Okay, please go ahead.
With those interested in the financial statement,
Okay,
supposing I'm a private company,
okay.
can the community in which I operate demand for a financial statement or demand to know my financial position?
Yes, yes and no. Yes, if your activity impacts significantly on the environment or the community in which you operate. For instance, let's say you are operating, let me say, a small scale mining organization. You're investing in a small scale mining organization. You know the impact mining organizations have on our environment. Now, the community, the people living in the community would want to know what kind of investment, how much money are you pushing in to ensure that you clean the mess that you are causing over the years. So they would want to see last year, how much did you commit? This year, how much have you committed? Next year, how much are you going to commit? So they would want to see all these. That will help them to know whether you are a serious organization or not. Now, know that even though you are a private entity, as long as your activity has an impact on the community is a key stakeholder in your organization, whether you like it or not. Because if they are not happy with your activities, they can stage choboi, and then the next day, government can withdraw your license. You cannot operate. Or they will destroy your image by going to length and breadth, going on air to destroy your image. You are not a human-centered, you are not whatever. They will destroy your image. The next moment, you realize that people are not interested in buying from you as an organization because you are not people-centered. So you may not directly think that these people should be your stakeholders, but technically they are, because they have an interest. Unless your activities don't impact significantly on the environment, then they will not be a key stakeholder. I hope that is clear, sir.
Yes, sir. A second question.
Okay.
How are dividends calculated?
Well, usually dividend are calculated based on what profit the organization has made. So sometimes they will say, it depends on what we call dividend policy of the organization. Now, dividend policy, all things being equal, is expected to be stable. So if organization A decides that for us, our dividend policy is that anytime we make a profit or anytime we make profit, 10% or a certain percentage of the profit will be paid out as dividend. That is the organization's dividend policy. And so if you are going in to invest in that organization, you are aware already what their dividend policy is. So that if you make a profit of 10,000 cedis, you know that they would pay 10% of the 10,000 as dividend to their shareholders. Or an organization can say, our dividend policy is that we're going to maintain a constant growth of dividend. So that if this year we paid 10,000 cedis as absolute amount, in terms of absolute amount, how much we paid out as dividend, next year we'll grow the dividend by just 10%. So it doesn't matter what level of profit they have made. Whether the profit is low or high, they are going to increase dividend by a certain margin of, say, 10%. So if last year they paid 10,000 cedis to all shareholders as their dividend, this year they are going to pay, or next year they are going to pay 11,000. The following year they will pay 10% of what? 11,000, that kind of thing. So dividend policy, actually, before you even venture into investing in an organization, you have to find out what their dividend policy is. Some organizations too, their policy is that, look, we are not interested in paying dividend every year. We pay dividend every other year. So 2 years, they pay dividend. Or 5 years, they pay dividend. Their key interest is in growing the organization, making it big, so that eventually you can cash out from your what? Investment. So this is how dividends are paid. I hope I've clarified your... Hello?
Yes, thank you.
All right, welcome. Any more questions? Okay, no more questions. So now let's look at financial ratios. Basically, most of the interpretation of a financial report comes from what we call financial ratios. So all the figures you see in the financial report, your statement of financial position, your statement of comprehensive income, they can be put in ratios so that it can give you an informed view of the financial report. So we'll take a look at these ratios one after the other. But before then, let's look at the advantages, or let me skip them. This is something readable. But let me just touch on them quickly. So advantages or significance of financial ratios. Financial ratios provide management information on operating efficiency, how efficiently the organization is operating. Sometimes by just looking at the financials on the face of it, you may not be able to tell whether the organization is performing efficiently or operating efficiently until you perform or you extract financial ratios. Financial ratios are also useful for intercompany comparisons. You want to compare different organizations, you can use financial ratios to compare their performance. Okay, so you may want to compare an organization that is big to an organization that is small. The organization that is big may be generating more revenue, but may not be doing well in terms of what? Profit, because probably their costs are too high. A smaller organization may be getting small revenue, but they're able to manage their costs and make a lot of profit. So when you extract the ratios, you'll be able to compare the two organizations and tell which one is doing well. The fact that you're a big organization doesn't necessarily mean you are doing well, or the fact that your revenue is even growing. Last year, you made a revenue of 1 million. This year, you made 1.5 million. It doesn't necessarily mean that this organization is performing well until you extract financial ratios. Financial ratios can be used to predict failure or success of an organization. This is also very true. You can use financial ratios, maybe historic financial ratios from last 5 years to this year, and then you can project to the next 5 years, and you'll be able to tell whether this organization will continue to exist in the next 5 years based on the ratios that you have extracted. It can also help management to take decision on whether to continue with a line of business or product or to discontinue it. So maybe you are providing insurance, national health insurance to your client. You would want to see, based on the ratios, whether to continue to engage national health insurance, or you want to switch to private health insurance, or even among the private health insurance organizations, which ones should you be doing the business with? Because some of them may not be paying you in time enough. Some will wait at the end of the year or 2 years before they pay you, or they pay you in bits. Or you are outsourcing some of your services to some private labs, private hospitals, diagnostic centers. How well are they doing? Would you want to continue to keep them as your outsourced organizations, or what? All these will come from what? Financial ratios. It helps management to identify the relative contribution of an asset. This aids management to decide whether to outsource the asset or dispose of it. You have a huge equipment sitting in your theater. How much is that equipment bringing you as an organization? Or you have a huge equipment sitting in your lab. How much is that equipment bringing you? So the ratios will be able to tell you whether you should continue to what? To use that equipment or dispose of it. Maybe another organization wants it. It could be that when buying the equipment, you didn't do due diligence. You just looked at what test the equipment can do, and then you quickly push money to go and get it. You brought it and you realize that no, Charlie, the cost of reagents are so high. And so you are not able to make what? The needed revenue. So financial ratios will be able to help you to decide whether to continue to use this equipment or dispose of it. Now, all these advantages are looking good, but there are disadvantages with using financial ratios. Now, remember that financial ratios are calculated based on what? Data. Now, if these data were not collected uniformly, then if you extract your financial ratios, you would be misled. So if the data that were extracted last 5 years, the basis of extracting those data, the basis of extracting those transactions were not correct, then it means that whatever ratios you are going to extract based on these data would not be correct, and so you'll be misled. So that is why accounting rules or accounting standards are supposed to be applied consistently. So that as a policy of an organization, if you have an accounting policy, that accounting policy is not expected to what? To change over the years. So for instance, if you have a policy on depreciating your computers for say 4 years, you are going to depreciate it over 4 years. You should not change it. We expect that consistently it is supposed to be what? It has to be 4 years. Don't change it. Let's say last year you changed it to 2 years. This year you've changed it to 3 years. Next year you want to change it to 5 years. There is no consistency. Once you change your accounting policy, it is going to have an impact on the figures you see in the financials. And so eventually the ratios you extract from it will also be affected. So thus is a limitation of what? Financial ratio analysis. The accounting periods covered by the financials may not reflect representative financial position. Many businesses produce financial statements to a due date on which there are relatively low amounts of trading activities. If trade is seasonal, the items in the statement of financial position may not be representative of values throughout the accounting period. So some organizations may deliberately even change their financial reporting dates. For instance, you report January to December every year. Let's say for the past 3 years, every year your report is from January to December. Now, this year you decided that no, we want to change from July to June. Financial year reports should be 1 year. So if you are reporting from January to December, that is 12 months, 1 year. We don't expect that you will change it and say, this year you're going to do from what? July to June next year. Or from 1st October to 30th September next year, that kind of thing. You shouldn't distort it. Because once you distort it, it is going to what? Affect the financial ratios. And again, some organizations, their activities are seasonal. Okay, and the season may be, let's say, just some 3 months out of the year. So once you change the reporting date, it is also going to affect the financial ratios or your financial analysis. So we expect that the financial reporting date should be consistently applied. If it is 1st January to 31st December, you should always have, unless there is a compelling reason for you to do that. Otherwise, you have to apply it consistently every year. Financial statements themselves have limitations. Example, they contain arbitrary estimates and figures which are based on personal decisions. Thus, is very true, especially regarding what we call depreciation, or for some organizations like financial organizations, sometimes we are expected to make an estimate of how much of your loans are going to fall into bad debt. All these are based on what? the experience of the finance director or the CEO or whoever is doing those things. It is going based on his experience. And so if you find a different person, that person may also take a different decision. So because of that changes, or because of this potential changes, your financial reports or your ratio analysis may be affected. Okay. Definition of financial ratios is sometimes not uniform. Definition of financial ratios is sometimes not uniform across companies and industries. This is also true because what financial institutions may decide as their ratio may not be applicable to a health organization or a health sector organization. What a communications organization may decide as their financial ratios may not necessarily apply to a pharmaceutical organization. So the financial ratios may not be consistently relevant across different organizations or sectors. So that is another limitation. Again, financial ratios are historical and do not tell management the health of the company now. All those figures, hello. Okay. So the figures that we have extracted, remember, we extracted them from what? Previous, let's say, activities that have gone on over the past year, past 6 months, past 8 months, and all those things. They are old data. They will not actually reflect what is happening now. They are historic. They are old information. They don't tell you what is happening now, today. So that is another setback. Differences in accounting policies, financial structures, financial policies, level of diversification, government incentive, production technologies, and buying policies. All of these also affect what? The financial interpretations or ratios interpretation. And then also there's something we call related party transactions. If your organization is related to another organization and there is a business or financial transactions between these organizations, chances are that it may not happen at an arm's length. What it means is that how you deal with an organization that is not a sister organization may be different from an organization that is a sister organization. And so the financial implications may be different. So if, let's say, you borrowed money from a sister organization and then you don't pay interest, if you had gone to borrow or pick that money from a bank, you would have paid interest on it. And then in your financials, we'll see interest. But because you took this money from your sister organization, it is a gentleman understanding. So they gave the money to you. After 6 months or 1 year, you give it back to them, the same amount. And these have financial implications. That's what we call related party transactions. Okay. Ratio analysis is one of the most widely used techniques used for analyzing financial statements. We've talked about that. Now let's look at the types of financial ratios. Basically, financial ratios can be grouped into what we call profitability ratios, liquidity ratios, asset management activity ratios, shareholder or investment ratio, and then financial leverage or gearing ratios. We'll look at them in turn. Now, profitability ratios. Now, profitability ratios are basically looking at things that have to do with what? Profit of the organization. Profit, anything that has profit, that is profitability ratio. And within profitability ratio, we have different types of ratios. Example is ROCE, ROCE, return on capital employed. Now, return on capital employed simply means that, look, you have put or you have invested a certain amount of capital into the organization. how much money or how much profit are you making out of the capital you pushed into the organization. That's what we call return on capital employed. And it has a formula. The formula is what? Profit before interest and tax. That is profits, the profit you got before you paid your interest on loans. Maybe you took some loans, you are paying interest. We want to know the profit. You see, when you have a revenue, you deduct your cost of what? Doing business. The ones that are directly related to the business, you pay them. Now, when you take that out, what you are left with is what we call gross profit. Now, the gross profit is a profit before you take any other operating expenses. So, for instance, interest, you've taken a loan, you want to take it out of that gross profit. Now, before you take out that gross profit, we want to know what profit it is. That is what we call what? Profit before interest. And then also tax, before you also pay your tax. So that profit that you have before you pay your interest and then you pay your tax is your what? PBIT. Now we want that profit and then you express it as a ratio over what? The capital that you pushed into the organization. That is what? Return on capital employed. Hope that is clear. Yes. It is expressed in terms of percentage. So your return on capital employed could be 20%, 30%, 15%, or whatsoever. All right. There is also what we call gross profit margin. I just spoke about gross profit. Gross profit simply means your revenue, and then you take out your cost of sales. That figure is your gross profit. Now, your gross profit divided by the sales, expressed as a percentage, is what we call gross profit margin. So oftentimes you hear margin. What margins are we making? What margins are we making? That is what? Gross profit margin. There's also what we call net profit margin. Net profit means that you would have taken other costs out of your gross profit to arrive at what we call net profit. And then the same way you express that as a percentage over your what? Your sales. So in terms of margins, you can look at gross profit margin or net profit margin. Okay, so that is what we have here, net profit margin. There's also what we call return on equity. Return on equity. Return on equity simply means that, look, how much did shareholders have in the organization? And then how much profit did they make at the end of the year? So here we are looking at our interest is just in what? Shareholders. Now know that it is not, shareholders are not the only people who finance an organization. I hope nobody would dispute that. It is not only shareholders who fund an organization. The bank that you took a loan from is also funding your organization. The supplier that you haven't paid is also funding your organization. Anybody that you are owing is funding your organization. So we are not interested in all those people. The people we are interested in is what? Is shareholders. Shareholders means what? Equity. If you remember when we were doing these things in the past weeks, we were talking about equity, equity, equity. Equity is the shareholders' stake in the organization. So we want to know the kind of return you are making to your shareholders. So it is simply what? Profit after tax or after tax earnings divided by what? Shareholders fund expressed as a percentage. That is referred to as what? Return on equity. So all these three we have seen, or four we have seen, are referred to as what? Profitability ratios. So if you look at this, it can tell you so many things about the organization. Now, having extracted your profitability ratios, you can use that as a comparative to last year's performance of the same organization, or you can use that to compare to industry performance. So let's say there's an industry performance measurement for all health sector organizations. So you look at your performance in terms of return on equity, return on capital employed, net profit margin, gross profit margin. And then you can compare to your peers within the organization, much as we do when we are doing any other comparisons. Okay, you can also do that and compare it to, let's say, a benchmark organization within your industry. There's an organization within your industry, let's say another health organization that is doing so well that you want to benchmark your performance against that organization so that you can improve on your performance. You can use all these financial ratios or profitability ratios to do that. It is acceptable. Okay, so that is about profitability ratios. Let's look at liquidity ratios. When we say liquidity, liquidity simply means what? Cash. An organization, as I mentioned earlier, can be very profitable, but if they don't have cash, if their cash position is bad, it's as that bad. It's that bad. Because remember, you need cash to do so many things. Cash is actually the currency of an organization. If you don't have cash, you cannot pay employees what? Salaries. If you don't have cash, you may not be able to pay your suppliers. If you don't have cash, you can't pay your taxes. If you don't have cash, you cannot renew your license with HEFRA. You cannot do basically nothing. So cash is very important. And for that matter, we have to what? Analyze cash ratios. That is what? Liquidity. How liquid the organization is. You may have assets. You have pushed money into buying equipment, building houses, or let's say offices or whatever. All those are investments. But we want to see how much cash is coming out of all those investments for us to what? To make an informed decision as employees, whether we should continue to work with you, as suppliers, whether we should continue to supply you your consumables or whatever. So we are interested. Now, to analyze the liquidity ratio, we have what we call current ratio. Current ratio simply means you look at your current assets, okay? The total of your current assets, all your current assets, divided by what? Your current liabilities. Now, the current ratio tells you whether you are that liquid as an organization, whether you will be able to pay your liabilities when they fall due. That is, for instance, if a supplier supplies, are you in a position to pay them? Anybody who is funding you, are you able to pay them? So you're looking at what? Current ratio. If the current ratio is big, the bigger the current ratio, the better. The smaller the current ratio, the bad. So you anticipate that current ratio should be big. So if you are comparing two organizations' current ratio, the one that has a bigger current ratio is better in terms of what? Liquidity. Okay. Now, there's a rule of thumb that says that current ratio should be at least 2, so that your current asset should be able to swallow your current liabilities 2 times at least. So if you have a current asset of say 20,000 and your current liabilities is 10,000, 20,000 divided by 10,000 gives you what? 2. That should be your minimum threshold. If it is 3, if it is 5, if it is 10, the better. So if you are comparing your previous performance to your current performance, the ones that give you current ratio that is high means that what? Those periods are doing better, or those organizations are doing better. Now, there's something close to current ratio we call quick ratio. Quick ratio, the only difference between quick ratio and current ratio is that there is a deduction of what? Inventory. It's the same formula. The only difference is that you remove inventory from your what? Current assets. Because inventory is money that is tied up in your organization. In your stores, all those things in your stores are referred to as what? Your inventory. So we want to take them out because it is not cash. We want to deal with things that have immediate cash implications. So you take your current ratio out and then you divide that figure by what? Your current liabilities. And the same interpretation, if quick ratio is bigger, then the better. All right. Another way of measuring liquidity ratio is what we call cash ratio. Cash ratio simply means you are totaling your cash and bank, all the monies you have in your safe or your cash in hand, the monies you have received and you haven't banked yet, plus what you have in the bank, plus all your short-term securities. Okay, you've gone to collect some short-term loans from your banks. You put all that together and divide by your current liability. That is referred to as what? Cash ratio. The bigger your cash ratio interpretation is that cash ratio of 1:2 is considered acceptable. It means that 1 Ghana cedi liquid assets are considered adequate to pay 2 cedis of current liabilities. So the more of the cash that you have compared to the liabilities that you have, the better. Because at the end of the day, we want you to be able to pay your liabilities when they fall due. All right. So this is about what? Cash ratios. Liquidity ratios. Now, there's something we call asset management or activity ratios. Now, as an organization, you trade, and some of your trade is such that, look, you don't collect cash immediately. For instance, when you render services to national health insurance and private health insurances, they don't pay you immediately. You take care of the patient, provide the service, and then they pay you later. Now, you want to know how much or how long does it take to do all these collections within the year. So out of the 365 days you have in a year, or out of the 12 months in a year, or out of the 52 weeks you have in a year, how much of your receivables are you able to collect within that year? So what it means is that your average collection period, you can measure them in terms of what? Days, in terms of months, or in terms of weeks. Now, if you are measuring them in terms of days, you multiply by 365 days. That is your accounts receivable divided by your annual credit sales. You multiply by 365, and it will give you an answer in terms of days. So that if you get 45 days, it means that you collect your receivables, all the monies that the health insurance people don't pay. They would have paid it within 45 days in a year. Or 3 months. If you are measuring it in months, you get, let's say your answer is 3 months. It means that you're able to collect your receivables within 3 months. If you measure it in terms of weeks, it means you are multiplying this by what? 52 weeks, because there are 52 weeks within a year. The answer you get tells you that you are able to collect your receivables within what? That number of weeks, let's say 12 weeks out of the 52 weeks. So this gives you a sense of what? Performance, or a sense of what? Measurement, so that you can compare to last year. Last year, how many days was it taking you to receive money from your health insurance providers, as against this year, as against next year, in terms of what? Your projections. So all these, you can pick the financial statement and be able to extract, because in your financial statement, you have account receivable balance, it is there. Annual credit sales, it is there. All these are figures we pick from what? The financial statement, and be able to make what? An informed decision based on the interpretations we have. I saw a hand up. Senior, Tavia.
Yeah, relative.
Yeah.
Can we go back a little? The current ratio.
Current ratio, okay.
I think the current assets.
Okay.
Current assets.
Current assets.
Current assets. I think apart from the cash you have and the money in bank, the receivables too are part of it, right?
The receivables are part.
Are they part of the current assets?
Receivables are part of current assets.
Okay.
They are part.
Okay. So if you use this to do your calculation, if it happens that some of your receivables default,
okay,
what happens?
So what you do is that usually there is a default rate. I mean, based on your experience in dealing with these customers or clients, you know that Osimesi, if he's owing you, anytime he's owing you, say 10,000, he will pay 9,900. That, as for that 100 cedis, he will not pay. So you incorporate it, you do an adjustment. so that you write off that 100 cedis as bad debt. Because realistically, what you get from Osimesi is 9,900, not 10,000. So don't use the 10,000, use 9,900. That is, you are being realistic. But if you use the 10,000, you are only going to deceive yourself.
Okay.
All right.
All right. Yeah.
And hello. And then let me also add
hello.
that before I come to you, please hold on a bit. Let me also add that because these financial reports are information that have happened in the past, they are actually what has happened in the past. So you may not actually even adjust it, because if at the end of the year, somebody was owing you 10,000 cedis, you are looking at how much the person was owing you to what? To use to prepare your ratios. Unless, that's why we said when we're looking at the setbacks or the potential pitfalls with financial ratios, limitations, we mentioned that financial ratios are based on what? Past information. They don't reflect what? Current information. Financial ratios are historical and do not tell management the health of the company now. So if you're talking about now, you may want to take that 100 cedis out. But if you're talking about the past, what has happened in the past, you may have to what? Look at the full figure. I hope that is clear.
Yes.
All right. So the next question, please.
Okay, so let's assume you are done preparing your financial reports.
Okay.
And then I quite remember where my company once was working with National Health Insurance Scheme before. And then after payment of their debts, they came back to do vetting. They were done paying for that month. They came back to do vetting. And during the vetting, they brought up a whole lot of issues and this and that and that. So they have to deduct some money again.
Okay.
So all those money, they've already paid, but they came back to do vetting. So they were going to deduct from the previous, from the current one that they are owing.
Okay.
So how are you going to bring out this report to match with the month they've paid and this one they are owing, and they are taking the money, last year's money against this year?
Okay. All right. So what it is that once you have agreed to pay that money, okay, if you have agreed to pay for whatever reason, you have to pay. Now, if you are paying it, it is going to be charged against this year's or this month's income or performance. You just have to acknowledge that this is like, it is a new something. It is a new expense you are going to pay. So you recognize it in this year. You don't have to go and do an adjustment to last period's report. You can't do that. You can't do that. When we get to, I think some of the models will discuss things like that when we come to audit and all those things. But this is not, but essentially what it is that this is something that you are owing now, even though it is because of a previous transaction. You are owing it now, so you have to pay it now, unless you want to defer it. But there's no way you can go back and adjust the previous ones. Now, if it is a whole year's report you have sent, okay, and then now this thing has come, you expect that you capture this in your narratives. When we're looking at the what do you call it, ratios, we talked about the users of financials and what they expect. We talked about the fact that we expect directors to talk about what? Narrative report. So in the narrative report, this thing can come out because you are going to charge it against this year's report. And so it may look weird. It may seem that this year you've paid so much. And so that explanatory report will be able to explain why you are paying so much in terms of what? Reimbursement to what? National health insurance or whatever it is. I hope that is clear. So the narrative will make the explanations clearer or the financials clearer.
Very clear.
All right, thank you. All right, so let's go on if there's no more question. Okay, so we just finished talking about your average collection period. So this is applicable to, apart from your health insurance that you are not collecting them now, if you are dealing with any other organization where you are selling on credit, you can use this average collection period to determine your performance. It's applicable everywhere. Okay. Let's look at inventory turnover. Now, inventory turnover, usually the kind of business many of us do is that, look, we buy our inputs and then come and store them. So if it is consumables, we come and put them in our stores. If it is reagents, we are putting them there. These are referred to as what? Inventory. Now, we want to know, now remember that it is money we use to buy those things. And the quicker we turn this into cash, the better. You don't want to buy reagents and put them there for 2 years before using them. You don't want to buy drugs and keep them in your stores for 2 years before patients come for them. You want that when you buy them within 1 year, all of the ones you bought within this year, all of them should go. That is what we refer to as what? Turnover, inventory turnover. Okay, so you're looking at the sales or cost of goods sold over your average inventory. How long does it take you to turn your goods into what? Into cash. You see, so the ratio measures the stock in relation to turnover in order to determine how often the stock turns over in the business. How often do you turn it? So here, let me ask this question. An inventory turnover that is high compared to an industry inventory turnover that is low, which one is better? And why? Anybody with an answer? Hello? I'm also asking a question.
Can I give it a try?
Yes, please. And you explain, please.
Let me try.
Okay.
I believe that when you have a low inventory turnover, then it means you are not doing well. But when you have a high inventory turnover, then it means you are doing well. You are selling more often than expected.
Okay. Any reason? It means you are selling more than expected. Hello, Mr. Mari?
It means it means your goods keep going as it comes, it goes.
So
it doesn't stay for long.
The bigger the better, or the smaller the better?
I think the smaller the better.
Okay, so that's your answer. Can we get another answer? A contrary view? If it is the same, you may not have to. We want somebody with a contrary view. Hello? Should I give that as an assignment? Yes.
No assignment.
No. Then let's give it a try, or I should allow you to think over it. Okay, so you think over it. I'll come for my answer at the end of the period. We have just about 30 minutes to finish. I want us to wrap up. Okay, so let's look at the same inventory turnover. We have several ways of measuring it. This is one of it. Another way of measuring is stock turnover period. This one will measure your stock turnover. When you see stock is the same as inventory. It is calculated as average inventory divided by your cost of sales times 365 days, if you want to measure it in terms of days, times 12 months, if you want to measure it in terms of months, times 52 weeks, if you want to measure it in terms of weeks. So here, it is telling us the same thing. How often are you turning your inventory? Out of the 365 days, how long is it taking you to turn over your inventory? So here too, the bigger, the better, or the smaller, the better. Any answer? Quick one. No answer? Okay, let's move on. I'll come for my answers later. All right. There's also what we refer to as total assets turnover. The assets that you have in the organization, what is the turnover from the asset? You have an equipment sitting there in your facility. Okay, what kind of sales is that asset bringing you? That is what we call what? Asset turnover. And the formula is sales over what? Total assets. For all the sales you have made from your assets divided by your total assets, that is what? Total assets turnover. There's also what we call fixed assets turnover. Okay, it is very similar to assets turnover. And the formula is also similar. It is sales, but this time you divide by what? Net fixed assets. The assets that are fixed. You know, some assets are not fixed. Some assets are fixed. So we are considering what? Just the fixed assets. For instance, your buildings, your office buildings, your, what do you call it? Your huge equipment, all of that. All right. Payables payment period. Now, you as an organization, you also are being rendered some services. Okay, your somebody is rendering services to you and you pay on credit. You don't pay immediately. You want to know, okay, these people are referred to as your trade creditors. How often does it take you to pay them? Now, here, there's an interesting twist. If it is taking you a long time to pay them, remember that because they are your creditors, they are giving you some services, but you don't pay them immediately. Essentially, they are financing you. They are providing you money to finance your organization. So the longer, the better. The longer, the better. But it also has implications. If it is taking you too long to pay them, it will get to a time that they will not be interested in doing business with you. So imagine somebody has supplied drugs, somebody has supplied reagents for you, and you use that to generate money, and you only paid it after 2 years or after a year. They will not be happy in doing business with you. Or if they are going to do business with you, probably they will increase the cost of doing business with you. So if the raw materials or the reagent is costing actually 100 cedis, they will tell you it's costing 500 cedis because they know that it will take you a long time to pay. And it means that you're actually paying 5 times what you are supposed to pay. Is that what you want to do? All right. So it's like a two-way sword. So suppliers will be interested in that kind of ratio. Now let's look at shareholders or investor or investment ratios. We call something earnings per share. Earnings per share. How much are you earning for each amount of share you have in the organization? So if you have an interest in, say, MTN, which is listed on the Ghana Stock Exchange, how much money you made from MTN as a percentage of the number of shares that is in the organization? That is what we call what? Earnings per share. We will not dwell so much on earnings per share here. We'll just run over it because it is not too much our interest. Again, there's something we call dividend per share. The dividend that you have been paid, we saw that earlier. How much is that dividend per the amount of shares you have in the organization? We are doing this because you want to compare. That's a ratio. You want to compare. Maybe you have an investment in organization A, another investment in organization B. Both of them have paid you 10,000 cedis as dividend. But organization A, you have 20,000 shares in that organization. Organization B, you have 5,000 shares in that organization. The dividend per share will be able to tell you which of the two organizations is giving you better value for money in terms of dividend. I hope that is clear. Because organization A, you have 20,000 shares, and so you expect more dividend. Organization B, you have only 5,000 shares. So if they are both paying you dividend of 10,000 cedis, organization A's dividend per share is going to be what? 10,000 cedis divided by what? 20,000, which is what? 0.5, right? Yes, 0.5. Organization B, they've paid you what? 10,000. And then the dividend, sorry, the shares is what? 5,000. 10,000 divided by 5,000 is what? Is 2. So 0.5 compared to 2, which one is better? 2 is better. So the dividend per share of 2 is better than the dividend per share of 0.5. Okay. Earnings yield. Earnings yield, this one is also relevant for organizations that are listed on the stock exchange. So here you are looking at your earnings as a percentage of what? The market share or the market price of the organization, expressed as a percentage. The bigger the earnings yield, the better. The bigger the earnings yield, the better. There's also what we call dividend yield, which is also similar to earnings yield. Here we are interested in dividend. Here we are interested in dividend. Now remember, I mentioned earlier that as a shareholder, you're interested in two things. You're interested in either taking dividend now or waiting and pick it later in the form of what? Expansion in the share price or the size of the organization. So all the earnings you have got, whether in terms of expansion of the organization or in terms of dividend, are the earnings you have had as an investor. You express that as a percentage of the market price of the organization, and that gives you your earnings yield. Now, you can only also be interested in just the dividend, and so what you extract is what? Dividend yield. You're looking at the dividend per share divided by what? Your market price per share. So the two look alike, but the interest is different. Here we are looking at dividend, here we are looking at what? Earnings. Okay. I'll not talk about price earnings ratio. We are not too interested in that. Let's look at dividend cover. Now, dividend cover, I talked about it earlier. Dividend cover here, we are looking at the earnings, okay, per share divided by your dividend per share. i.e., explanation is that, look, how much earnings are you making as compared to the dividend? How much or how many times your dividend, your earnings is covering your dividend? So if you are earning 100 cedis and your dividend is 1 cedi, how many times can your earnings cover your dividend? We talked about this earlier. That is dividend cover. Now, dividend payout ratio. Somebody asked the question, how do you calculate dividend? This is what we call dividend payout ratio. I explained that. Dividend payout ratio, you are looking at what ratio of your earnings are you paying out as dividend? That is what we call it, dividend payout ratio. Dividend payout ratio. How much have you made as against how much you are paying out? Okay, and so the calculation is that equity share dividend, that is dividend payable, divided by the earnings available to equity shareholders. That is all the earnings or the profit you have made that is available or that is for the shareholders. And then you are taking the dividend out of it. The dividend divided by that money is what we call dividend payout ratio. So this is expressed in terms of what? Percentage. So if your dividend payout ratio is 20%, it means that the profit you made, you are paying 20% out of it as dividend. That is what? Dividend payout ratio. Dividend payout ratio. Okay. And you can also calculate that as what? Dividend per share over earnings per share, expressed as a percentage. It's the same thing. Okay. Now, let's look at another aspect of ratio as what? Gearing or financial leverage ratio. Gearing. When we say gearing in finance, they are looking at debt. Some organizations go for what? Debt. Remember, you can finance organizations mainly by taking money from your shareholders or by taking loans or debt. Okay. Now, some organizations can take on a lot of loans for obvious reasons. There are reasons we are not interested in for now. You can take out a loan instead of going to ask your shareholders to bring you money. Now, it is good. There are financial reasons for taking up loans, but if you take too much loans, it can also swallow the organization. So there's something we call debt to equity ratio. Debt to equity ratio. In terms of the monies available to finance the organization, how much of it is debt, or what ratio or what quantity is debt and what quantity is what? Equity. So you can express this as debt is to equity. Let's say 2:3. That is 2 debt, 3 equity. Meaning if you have a total of 5 in terms of funds available to the organization, 2 out of that 5 is debt. 3 out of that 5 is equity. That is what we refer to as what? Debt to equity ratio. So you can express this as a simple ratio, or you can express it as a percentage. And in that case, you are going to divide your debt, which is your long-term loan, plus your preference share, which is your total debt, divided by what? Your equity shares and surpluses. Or in simple terms, total debt divided by what? Shareholders fund. That is what? Debt to equity ratio. Now, if you hear that an organization is highly geared, it means that this organization is taking too much loan. Too much loan. We can liken it to the government of Ghana, taking so much loan. So Ghana is highly geared. And you see what is happening. Loan is good, but if you take too much of it, it can swallow you. All right. There's something we also call equity to asset ratio. Now, remember we said that earlier, we talked about the fact that if your shareholders bring money into the organization, you use that money to buy assets. You use that to buy equipment, you use that to rent offices, you use that to buy reagents, consumables, drugs, and all those things. Now, we want to see the ratio between the equity fund and the assets you have in the organization. That is what we refer to as what? Equity ratio. Equity shares, capital plus surpluses over what? Your total assets. A high equity to asset ratio means that most or all of the long-term capital is equity, and that much of the business is financed by what? Equity fund. A low equity to asset ratio means that much of the business is financed by loans. So this tells you that if you have higher equity to asset ratio, it means that what? It is being financed by what? Equity, largely. If it is small or if it is less, then it means we are financing it with what? With loans. And so if you extract these ratios, you can use that to compare what? Performance of 2 or more different organizations or the same organization year on year on year on. All right. The reverse is what we call what? Debt ratio. You are looking at your long-term debt divided by your assets. The higher the debt ratio, the more difficult it becomes for the firm to raise debt. If your debt ratio is high, Ghana's debt ratio to GDP is about 80%. So it means all the money you have, when you collect the money, you spend about 80% to pay for your loans, which is not good enough. So you can also look at this in terms of what? Business organizations and etc., etc., etc. Okay. We'll talk about interest cover ratio. We've talked about that. I've actually explained this earlier, just that I didn't mention it clearly. I told you that, I mentioned that interest cover is, you're looking at the interest you are paying as against the profit you have made. How many times will your profit be able to pay the interest? And this is something who will be interested in? The banks. Because you've taken a loan from them, they want to know how much your earnings can pay their interest. and so they will continue to do business with you or otherwise. Okay, we've talked about fixed dividend, or we've talked about dividend cover too. It's the same explanation, just that the formula is different. Okay, so this is about financial ratios. This is about financial ratios. And like we said, you can use financial ratios to measure the performance of your organization. And you can pick this information from your financials, i.e. your statement of comprehensive income and your statement of what? Financial position. All right. Any question on what we have done so far? And I want to believe that I've been able to explain it well. I've not used very technical words. If I have, I've explained them. If not, I would want to know so that I can break them down or offer more explanation. Okay. So the floor is open for questions. No question means that it's been clearly understood, or I've already explained what bothers your mind. And so there are no further questions. Any concerns? Any issues?
That's that I didn't hear hematology accounting.
You didn't hear what?
Accounting hematology.
Hey. Which one is accounting hematology?
I said you have done well, but that I didn't hear accounting hematology in the presentation.
Okay. Any more? Xavier?
No question.
Okay. Esther?
Mr. Latif, can you
Yes.
go back to answer the question you asked us?
Oh, that question is your own question. Oh. That one, you are supposed to answer that question. If not, it will be your assignment.
That's my question.
That one it will be your assignment.
Mr. Latif.
Yes.
You said if you borrow too much, it's called what? Geared what?
Gearing, highly geared.
Highly geared.
G-E-A-R. Geared, just like the car gear.
Okay, highly geared.
Highly
All
geared.
right. For example, government of.
You can also hear highly leveraged.
Okay.
Here, an organization is highly leveraged or highly geared.
Thank
And
you.
it means that they are taking so much debt.
All right.
Okay. And like I said, we are not interested in the reason why debt is good, but financially debt is very good. There are reasons, but it's not for the purposes of this course. There are very good reasons why you should take up loans.
Mr. Latif?
Yes.
Earlier on, you said a company can have a lot of profits, but no money or capital.
No cash.
No money, no cash. Yeah.
Yes.
Can you explain that, please?
Okay. So let me explain this simply because let's say, typically, the simple reason is that, look, if you render business on credit, okay, you can do so well. But remember, if you're not able to collect the money in terms of cash, you don't have cash. So in terms of profitability, you would have done so much in terms of revenue, okay? Because whether you collect cash for a service rendered or not, it is revenue. Whether you collect cash from health insurance or not, it is revenue. You have to account for it as revenue. But when you come to your cash, you have not taken that cash from health insurance. So you don't have enough cash, but you have enough revenue to boost your what? Your profitability.
In other words,
in other words,
it's a receivable.
It's a receivable. So you have so much receivable sitting up there in your account, in your current assets. Huge receivables, but you haven't received it. Now, when you are passing the journals, remember it is debit credit. If you have rendered service to health insurance, they haven't paid. It is income. So the credit goes to your income. Remember, income is what? Credit.
Credited.
Right? It's credit. Yeah. It is there. And then the debit goes in what? In your what? Receivable. So that leg, the debit is in your receivable, the credit is in your what? In your income statement as your income. So you have had so much income up there, but you have nothing to show in terms of what? Cash, because all of it is held up as what? Receivables. So you have to make efforts to collect your monies. Now, if later you collect your money, it won't come in as what? As income again, because you have recognized that income already. So the cash that is coming from health insurance, if you have collecting or you are collecting it, what journal are you going to pass? That money is going to add up to your what? To your cash. Remember, cash is debit. So it's going to increase your what? Your cash. So you debit cash to increase it. Where will the credit go? The credit will go and reduce what? Your receivables. Remember, receivables is what? It's a debit. So if you are going to credit it, it will reduce it. Is that clear?
Okay.
Yes.
Yeah.
Okay. So that money you are receiving later, you wouldn't recognize it as what? Income, because you have recognized income already. So the two legs that are going to be passed is that the debit would go and increase your cash because you are receiving cash. The credit will go and reduce the receivables because the guy is no longer owing you. So you have to reduce his indebtedness to you. So debit and credit should always make sense. All right. Okay. So that is why profitability is not the same as what? Cash. The fact that you are making so much profit doesn't mean you have enough cash. And in fact, some organizations actually, buy other organizations just because they have seen that this organization is very, very, very liquid. Very, very, very liquid. So maybe by way of the nature of your organization, it is such that, look, it is hard for you to have sufficient cash. So what do you want to do? You want to buy an organization as part of your group of companies so that that organization will serve as what? Cash cow. It will always be bringing you what? Cash, because that organization is very, 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 very liquid. So these are some of the reasons why you see some organizations interested in other organizations because of their cash position. Cash is king. All right. I hope I've been able to explain that.
Yes. Thank you.
You're welcome. Any other question? Three minutes to time.
So, hello, Mr. Latif.
Yes.
This is lecture 5, right?
This is lecture 5, yes.
Okay, thank
you. So that's
you.
for next week.
All right, sir. Thank you.
You're welcome. Okay, so let me explain this. I was asking about the average collection period. There are several formulas. With this formula, you're looking at average collection period, how much your account receivable is compared to what? Annual credit sales. Now remember that if your receivables is low, okay, receivables is a debit, right? Compared to the credit sales you have made, the better, isn't it? So here, the lower, the better. And that is the explanation Mr. Omare offered. So the lower, the better. Now let's look at this formula. Inventory turnover is equal to what? Sales or cost of goods sold over average inventory. Remember we said that inventory, you don't have to keep plenty inventory. It has to be small. Sales has to be big. The bigger the sales, the better. So here, the bigger the inventory turnover, the better. So more sales, less inventory. And you know that inventory is the denominator. The lower, the bigger. Sales is the numerator. The bigger the inventory turnover. All right. Gloria, your question, please. I can see your hand up. Hello, Gloria.
Yes, Senior Latif.
Hello, Gloria. Can we hear your question, please?
Hello.
Hello, I can hear you, please.
Please, when you were explaining it, there was some breakages in your voice. So I couldn't really hear you all.
Okay. So I was saying that the average collection period, okay, if you want to know whether the bigger the better or the smaller the bigger, look at this. Accounts receivable. We said that accounts receivable, this is services you have rendered that you haven't collected cash for. And we don't want so much of it. It should be small so that you can get your cash quickly. Annual credit sales. Credit sales, all things being equal, we don't want credit sales. We want cash sales because we want to have what? More money. So here, the smaller, the better. And I was explaining that because you want your receivables to be small and then your credit sales to also be what? To be small. The average collection period should be small relatively in the whole year so that you don't spend so much time collecting your what? Your receivables. With this formula, we are saying that the formula is what? Inventory turnover is going to be what? Sales over what? Average inventory. Here, the sales is being compared to what? Average inventory. Here, the inventory turnover should be what? Should be bigger because your sales is the numerator and then your denominator is your average inventory. Average inventory, we want it to be as small as possible because nobody is interested in putting so much money in what? In inventory. You keep them in your stores and then you are not making anything out of it. So we keep inventory as low as possible. And because it's the denominator, the smaller, the bigger the inventory turnover. And your sales is what? Numerator. The bigger, the better. Or the bigger the inventory turnover. Is that clear?
Yes, please.
Okay. Now, I didn't talk about this, but I mean, it's in the notes. When we say average inventory, usually it is calculated as opening inventory plus closing inventory. We haven't talked about opening inventory and closing inventory. Opening inventory simply means the inventory at the beginning of the year, closing inventory is inventory at the end of the year. You find the average. So you can get it from the financial statement. So everything here, you should be able to pick it from what? The financial statement. Either your statement of comprehensive income or your statement of financial position. All of it will be there. Now, let me also explain this. It is not here, but let me take time to explain. Now, there's a good reason why it is required that when you send your financial report to either your shareholders, your members, potential investors, or whatever, you should provide what we call comparative reports. So if you are presenting this year's, or let me say last year's report, you should present last 2 years' report as well. And if possible, last 3 years' report as well, so that they can make an informed decision based on the trend performance of the organization. If you present them only 1 year's report, at times it's difficult for them to make a judgment. Because for instance, if you say your revenue was 1 million, and so what? How do I know whether this 1 million is an improved performance or not? Until you provide me the previous year's performance or the previous year's report. So I can compare and be able to tell, oh, last year you did 800,000. This year you did 1 million. So there is an improvement over last year. And this is the simplest kind of financial ratio you can look at. That is last year's report over this year's report as performance, expressed as a what? As a percentage. So last year 800, this year 1 million. The difference is what? 200. Divide by last year, expressed as what? A percentage. And that tells you the percentage increase in revenue. And you can apply this all throughout. Percentage increase in revenue, percentage increase in cost or decrease in cost, percentage increase in anything at all. You can use this to look at last year and this year and be able to tell whether there is an improvement or not. Okay. Any more questions? Our time is up. No question.
Okay, since time is up, school is over.
So there's a question here we'll be sharing with you later. We have statement of financial position, statement of, yes, 2 statements of financial positions, and we expect you to do a performance analysis. So you use all those ratios we have provided you to extract. And you can see here just what I was talking about. There's a comparative 2018 report, 2019 report, 2020 report. So you can measure performance across. You can see that here, 2018 total assets was 606 million, 2019 748, 2020 770. There is an improvement over the past 3 years. Liabilities or long-term loan. Long-term loan 2019 or 2018 74, 2019 138, 2020 138. So there has been an increase between 2018 and 2019, but it has remained the same over the last year. So it's just a comparison. Just look at it. Trade payables 53, 75 against 75, like that. So this one is very simple. I know all of us will be able to do it. So we'll share these with you, and then we'll expect a feedback to be able to do some small analysis. And then that'll be it. Okay. If there's no more question, I guess we can bring today's class to an end. Prof. Quay, I didn't hear your voice. And by the way, congrats. I'm getting to know about this for the first time. Prof, can we hear your voice more? Oh, Prof is gone. Oh.
I'm not a prof.
Oh, not yet.
No.
Okay, very soon.
Okay.
Okay. No questions from anywhere? All right. Then I guess it's a goodbye. God willing, we'll meet next week. Bye-bye.
Small money you give us, you are denying your prof.